Good morning, everyone. My name is Adam Myers and I lead the distribution team at Pengana. Thank you for joining us for this webinar update with Ted Franks, the manager of the Pengana Web Sustainable Impact Fund, and Seb Bilo, the head of research at Web Asset Management. Just a brief reminder for those who are less familiar with our business. At Pengana, our key aim is to offer differentiated strategies which will add value to our clients' portfolios. We have no Me Too funds across our business. And WEB's business is focused entirely on sustainable and impact investing. They have managed this fund since August 2007, when Pengana acquired it through the merger with Hunter Hall. The team are based in London, which is 11 hours behind us. So apologies for the early start, but it's already 9:30 in the evening for our presenters. Today, Ted will provide a third quarter update and a portfolio overview, and Seb will discuss some of the emerging technologies that the team are most excited about. During the presentation, if you have any questions, please enter them in the question box, and we will get to as many as possible in Q&A at the end. Ted, over to you.
Great. Thank you, Adam, and thank you everyone for joining in Australia. I hope it's not too early for you guys. As Adam said, it's towards the end of our day here, but hopefully we have a chance to cross over, and very pleased to have the opportunity to report and hopefully get some good questions and conversation from you guys. So without too much time hopefully spent on this, hopefully everyone can see the slides here. Just pause quickly on the disclaimer, as all good presenters should, and then off we go with today's webinar. Now, today's webinar is in two parts. We do a quarterly update every quarter, talk about the fund's performance. We have to necessarily be a little bit high level about that, but we can always take questions and people can reach us later on. Very happy to go into as much detail as possible. And there's a lot of reporting around what we do. We hope to be, one of our key aims is to be very transparent. And then after I've done the quarterly piece, this quarter we're going to talk about some of the really interesting, exciting breakthrough technological developments which are sort of embedded and incubated inside our portfolio, perhaps in slightly unexpected ways, and some of the sort of new initiatives that some of our companies are doing. And my colleague Seb Bilo is going to lead on that. So that's the topic for today. So starting with the Q3 update and the backdrop. What happened in the third quarter? Well, I'm sure those who've been watching markets will be aware of the first couple of these. The third might be something which is more sort of specialist to us. So the first one, the COVID second wave. Our fund is a developed markets fund, and actually notwithstanding the very different experience around the world, and of course I'm speaking to people in a country for whom the experience has been different and much better than ours up here in Western Europe. The third quarter was, including the summer months, which obviously had a big relative drop in cases and hospitalizations for COVID towards the end. Clear emergence of the second wave started to come through as we speak now. Markets have had an interestingly quite a dramatic day today as a response to to a spike in numbers in the US. And we've seen really this idea that actually all of the economic responses and repercussions of COVID are coming through again in the winter months as people expected. The point about this chart, of course, is to show, again, it feels like a second wave if you're sitting here in London. For most of the world, in terms of the actual human impact on it, it's still just one big wave of COVID. It's roaming around the world, and we still have quite a long way to go to get on top of it. Now, the other big feature of the third quarter was the run-up to the US election. And actually, we've been doing this strategy, well, the strategy's been around since the start of 2006. So we've seen many cycles of elections in various countries. Of course, the US is the most important one, really. What is interesting about this very acrimonious election cycle is the lines in the middle of the chart here. The relative position of the two candidates has not changed. And that has made, from an investment point of view, I mean, it's very gripping, but in terms of volatility and swings, it hasn't really changed an awful lot. And you would normally expect the election quarter to have more to think about in a way. But actually, in terms of our positioning, the sort of surprises haven't been there. And I've just put some pictures in there just to sort of highlight how unusual this is. These are 5 things I've chosen. It could have been many more that would, in an ordinary election cycle, would have completely changed the direction of what was going on. This is Trump's former aide arrested for fraud, denigrating the servicemen, having the reveal of his tax returns by the New York Times, failing to condemn white supremacists, then getting embroiled in the QAnon conspiracy theory. None of these factors made a difference, which is stunning, really. So that was something we were watching closely in the third quarter, which in a way didn't come to an awful lot. Now, this is the more interesting one from our point of view, sustainability-wise, and this is really, I think it feels quite profound. I mean, there has been a steady increase in the sustainability drumbeats now for, well, obviously, all the time we've been doing the decade or more we've been doing the strategy, but actually in the last 2 years, the steady sort of conversion of any of the positions of doubt and the great victories in some of the technological wins, particularly in terms of renewable energy, making it clear that they could be cheaper than the existing fossil technologies. But in the third quarter of this year, I think we've not seen anything like this in terms of the scale and the breadth and the ambition of the commitments, both from governments and from companies, and of course also from individuals really around the world getting to grips with what needs to be done. So some sort of headline examples: the EU's now gone for a 55% emissions reduction by 2030. That's a sort of sharpening of its ambition, already world leading. California's banned internal combustion engines by 2035, which in itself, actually in terms of internal combustion engines, isn't particularly breakthrough, but coming from a US state, it's a big deal. And then actually the most important in emissions in potential is China's ambition to be net zero carbon by 2060. And China is an interesting global participant in lots of areas at the moment, and not necessarily always positive, but that is a huge deal for the sustainability of the planet and really does set a new frame for, potentially a new frame for how we think about the future from here. So those are the big kind of macro features that we looked at in the third quarter. Now, turning our attention more specifically to the fund itself, we've had a good quarter, another quarter of relatively solid outperformance in the third quarter, our fourth successive quarter like that, and coming against a little bit more of the same headwind we've had all of this year, at least, in that our natural affinity for medium-sized companies, because they're the kind of most impactful ones, has been a little bit of a headwind. So we are pleased with that performance. Now, if we look back over the sort of 5-year view, which is something which we're always doing because that's our view, that's our frame, we try and tell people, you know, we ourselves invest over 5 years, so we'd like to see you as investors following the same sort of profile. You can see here we're now back ahead at the benchmark over 5 years, which is good. And with this sense that sustainability is coming into its own, I think we're feeling more and more confident about what the future holds. Digging a bit more deeply into where that performance came from, you know, as you know, we have 9 themes. We also have shown on this chart the thematic selection effect, which is the attribution against the rest of the universe that is not in one of our themes. That's effectively what answering the question, was sustainability a headwind or a tailwind in the quarter? And you can see that's down at the bottom there. It's a very mild headwind in this quarter, but otherwise broad-based success, right? So all of our themes doing particularly well, with obviously the one standout negative there, which is education. In the interest of time, I'm just going to touch on some of the key positives and obviously that negative as well before I hand over to Seb. So starting with resource efficiency. So resource efficiency is one of our 2 big themes. In fact, the 2 big themes are resource efficiency and health, which were the biggest 2 positive contributors in this quarter. The pandemic in general, we think, has been a validating experience for a lot of our companies, and particularly in the resource efficiency field, where they've also spoken, where the companies whose products also speak to resilience as well as efficiency. We've found that 2020 has been a good year for those companies. In the background to this, there was also, you know, these are often industrial companies in our resource efficiency theme, and there has been a global decrease in business sentiment. And the lines on the chart here are the purchasing managers indexes, which are a proxy for business confidence. And you can see from the middle of 2018, there was that weakening PMI. And actually what's notable, apart from the very, very striking drop in these lines, the sort of historic fall away in business confidence, is when those lines return back into frame, then actually that kind of inflection that you saw in the sort of late 2019 period has been continued upwards. And so I think this quarter has been there's been a little bit of extra juice there in terms of the cyclical names, and certainly some of the names that did well in this theme, which you can see on the chart here, RENISHAW, Daifuku and Smurfit Kappa, they have that cyclical overlay as well. So we've got sort of structural validation from the pandemic combined with a bit of cyclical oomph as well, which didn't have to be the case, and it is interesting that that's occurred that way. On the health side, we're continuing to see really broad-based strength across the entirety of the health theme. Three names in particular have obviously done, I say obviously, but it will become apparent, have done well in the pandemic. They are our life sciences tools companies, Thermo Fisher, Danaher, and Agilent. Clearly, these companies are a big part of providing the solution to the pandemic challenges, partly through their work with diagnostics inside hospitals and testing labs, but really particularly around some of the new drug discovery and vaccine discovery, of course, as well in their life sciences divisions. You can see these very, very striking organic growth rates. And actually, during the quarter, Thermo Fisher, which has arguably been the most successful of the three, did pre-announce its Q3 numbers, which were going to be good. And actually, they actually announced them last week, and I think it was 34% organic growth, which for a large company is really, really stunning. What this chart also shows you, of course, is that the bits of their business which are exposed to environmental markets, which we're also very interested in from the point of view of sustainability, are not performing so well at all. That's the applied environmental lines you can see there, but it's not able to detract from the positive momentum on the health side. Now, these guys did well. The rest of the health theme did well. The one that did best of all is a bit of a sadness for us, actually. So, goodbye Varian, company we've owned since 2013. It was bid for. We had a relatively healthy premium, although I think it could have perhaps been a little bit higher. It was bought by Siemens Healthineers, so it's disappeared now into the bowels of the Siemens machine. It's a shame. We really liked Varian. Varian was one of two and a half global leaders in radiotherapy, particularly around the sort of linear accelerator technology set. So obviously a very profoundly impactful product of its own, but Varian came from this kind of technological heritage. It knew what to do about radiation, knew how to deal with imaging, applied that to where it could apply it, which most obviously is oncology and cancer care. But you see, during the period we owned it, it sort of in a way became much more interesting. It spun away its imaging business and sort of departed from this technology track and instead kind of circled cancer itself. So it invested in proton therapy, it invested in software in particular, which was a big part of the new treatment paradigm. It invested in interventional oncology, and it also put a lot of money into more affordable versions of its machines for emerging markets, all of which was very kind of mission-centered, impact-centered thinking. We really liked that. And so we're sorry to see it go. And obviously we keep looking for companies which think that way, the same way Varian does. Now, the last little bit of sort of positive news before I deal with that negative performance from the education theme a little bit is to say that the other thing which helped us in this quarter was a few of our names where there were question marks over bits of their business which were seen as potential pandemic losers, actually reported for the second quarter in the third quarter, and things were much better and more resilient than people had expected. So Keon, although part of its business is definitely a pandemic winner, the part which isn't is its forklift trucks business, although we could talk about them. Their electric and fuel cell forklifts are very interesting in particular, but that actually turned out to be better than people feared. Cooper Companies, which has got a contact lenses business, which was supposed to be badly hit with new fittings in the pandemic, and that was not as bad as people thought. And then Xylem, with its exposure to the pump maker, broadly a pump maker, with a water equipment maker, with its exposure to municipalities, that was supposed to be under some pressure, and it did better than people expected, so that was good as well. Right, last slide for me before I pass over to Seb, and that is just talking a little bit about the education theme. Now, the point about this slide is, having said, in the broad macro picture, the election wasn't as full of twists and turns as we expected it to be. Certainly, some of our stocks do have political exposure, a small number really. The education stocks are two classics for this. So Grand Canyon Education and Strategic Education, both of them perceived as red, i.e. Republican stocks, because they're for-profit higher education providers. That's an industry which has had some bad actors in the past. Democratic administrations have tried to regulate that. Therefore, traditionally, if it looks like you're going from a Republican administration to a Democratic administration, they'll do badly. We think that's misguided. These are two very high quality operators with very good relationships, particularly for strategic with the Department of Education, and business models which really are about empowering disadvantaged groups to get into higher education, get themselves out into a more advantageous position in the jobs market. So under pressure because of the election. The reason for the empty chairs, of course, is it's not actually just the election. So the pandemic itself is clearly a problem for people who operate physical campuses. Both of these companies are very much in the vanguard of moving online. They've very much minimized where they can, or carefully controlled is the best way to put it, their physical campuses. But that was part of the reason they were under pressure. And worth just saying, on the other side of that coin, we do have a few, well, one in particular stock, which is very blue, and that's Centene, i.e. blue, perceived to be favored by a Democratic administration. Centene is our managed care provider in the US, particularly focused on the poorest groups in society with its offering for managed Medicaid, which is the American program for those that can't really afford healthcare. They're also a big beneficiary of the Obamacare process. And of course, whilst there's still political uncertainty, the stocks were under pressure. Stock was under pressure in the third quarter. In addition to the prospects, potentially slim, of a Trump victory, you also have the nomination to the Supreme Court of Amy Coney Barrett, which would potentially open the door for Obamacare being repealed. So what I'm saying here is, it looked like education was under a lot of pressure for political reasons. There may be other things going on there as well in the form of the campuses. So that is where I'm going to leave it for now. I'll come back to answer your questions shortly. And with that, Seb, I'll pass over to you. And Seb, I'll drop my screen and you can pick up, okay?
Great, thank you very much, Ted. I'm going to now talk to the second part of the presentation, which is looking at some of the emerging breakthrough businesses and technologies that we have in the portfolio. Many of you hopefully will know, or some of you at least will know, that we've been managing this strategy at WHEB now for nearly 9 years, and actually just a slightly shorter period before that at Henderson as well. And the focus has always been, the focus of the strategy has always been on companies providing solutions to sustainability challenges through the products and services that they sell. And our particular focus has been on the sort of sweet spot, our investment sweet spot has been on companies with commercialized products, with working technologies, but that are at that inflection. When you introduce a new technology or a new product into a market, you tend to see a relatively slow level of adoption and then an inflection point, and it follows a sort of S curve. It rapidly accelerates and then it tails off as you approach 100% penetration. And our particular focus has been on companies that are approaching that inflection point. And the question we sometimes get back from clients is whether we have enough exposure to the really disruptive breakthrough technologies that are typically brought to the market by smaller companies and a relatively earlier stage. And it's very easy to get very excited about these companies. They come with lots of marketing hype, and you have these wonderful kind of hockey stick growth charts. And we are, very much strong believers in the accelerating growth in many of these environmental markets. But we have learned to our cost that picking winners in this very early stage of technology is extremely difficult. Some of you, I'm sure, will be familiar with the so-called Gartner curve, this hype cycle, a sort of stylized chart showing the level of expectations around new technologies. And I've put various environmental technologies on this chart, and you typically get this sort of massive sort of acceleration in expectations as people get very excited about a new technology. And then you see a sort of equivalent collapse as reality takes place more slowly than people had kind of anticipated. You hit this very depressing trough of disillusionment, and then you get the growth coming through if you have a successful business. And choosing the technologies at the start of this curve is very difficult. You have to get the theme right, you have to get the market right, you have to get the company right, because of course there'll be lots of companies competing in that new market. And then you also have to get the point at which you buy the stock right and the point at which you sell it as well. So you have these 3 or 4 dimensions that you have to get right, and you have to do that routinely as well. And that's just an extremely difficult thing to do. And so our approach is really to find companies that already have commercially viable products that have a positive impact, of course, but they're companies with technologies that have already gone through this hype cycle. The product works, the company has a commercially viable business, and as a consequence, it offers a much lower risk, a more stable returns profile. But we're also very interested in companies that are high quality, that are well invested and focused on long-term value creation. So the WHEB portfolio is characterized by companies that, for example, have strong cash flow return on invested capital, as you can see on the chart on the left-hand side. They're relatively unlevered as well compared to the market and compared to our universe on the right-hand side. And they're also businesses that are pretty adept at managing their own environmental and social footprint and have strong governance structures. We're a bit leery about ESG ratings at a company level, and we don't use those in our investment process, but it's quite interesting to see how the portfolio is seen by some of these rating agencies. And this is MSCI ESG data that rate us in the 91st percentile in the global equity peer group. 100th percentile is the best, so 91 is a very good score. So these are companies that perform strongly from an ESG point of view. But perhaps most importantly, we're looking for companies that have real vision and ambition. They have a strong quality foundation, but they are also energetically pursuing and investing in breakthrough applications alongside their core business. So we do have exposure to breakthrough technologies, but it's typically through a more stable platform that's afforded by an existing, more mature business. So I'm now going to go through 6 examples. I'll canter through them quite quickly, but 6 examples of companies that have these characteristics, that have new products and services that represent the next wave of innovation, why they're interesting from an impact point of view, and also what they can mean for stock performance. So the first company I want to talk about is a company called DSM, which is a Dutch company. Originally, it stood for Dutch State Mines, actually. It was originally a coal producer over 100 years ago, and it's now changed its business model many times. And its focus now is just on human and animal nutrition, and they've actually just sold their engineering materials business. So it's solidly about making agriculture more efficient and improving diet and nutrition for humans. And the product that they're introducing is called Bovar, which is a feed additive, which is added to the feed for cattle. Now, livestock overall, as I'm sure, well, many of you I'm sure know, livestock on their own account for 15% of all greenhouse gas emissions globally. And cattle are about half of that. So about 8% of global greenhouse gas emissions come from cows, or more precisely from cows burping up methane, which is about 24 times more potent a greenhouse gas compared to carbon dioxide. So what DSM have done is they've developed this food additive, and it essentially helps the cow digest its food more efficiently and results in a reduction of methane by about 30%. So it's a significant reduction. If all cows were to be fed Bovar, that would reduce global greenhouse gas emissions by 2%. So it's a significant potential impact that they're having. And it also helps the farmer. It has no impact on the welfare of the animal, and actually allows, because the cow is digesting its food more efficiently, you can actually reduce the feed costs by about between 3 and 5%, because 10% of the cow's energy just goes into producing this methane, which we don't want. So that's the impact. It's now registered in Europe and should go on sale next year. They reckon at DSM that this is a market that could be as big as $2 billion. So a significant potential proportion of the company's revenues going forward. So that's the first example. The next example I want to talk about is Cooper, that Ted mentioned in his presentation as well. They have 2 main businesses. One is making contact lenses, and then the second is making medical devices for women's health. Within their contact lens business, they've now developed a new product called MySight, which has been tested and proven to help reduce the development of myopia in children, so to help reduce the development of short-sightedness in children. It slows the progression of myopia, as you can see in the slide here, and actually in a quarter of cases it actually arrests the development of myopia altogether. Now, myopia isn't just an inconvenience for people like me having to wear glasses, but if you have severe myopia, it can lead to other more damaging comorbidities like retinal detachment and cataracts and things like that. So this product, MySight, potentially can have a real impact on reducing the need for operations to deal with these other issues. At the moment, it's available in the UK, the US, Australia as well, and Canada. and it's being rolled out across the globe. The company reckoned that the potential market size is up to $5 billion. That would be for the 12 to 18 year groups that the product is targeted at. If it's used beyond that, then of course that market size will grow. But this is a big potential product for Cooper, and clearly delivers a significant positive impact. And then the next one, also within one of our smaller themes, education. And we think this is, again, an area that Ted has talked about. But we think this is a really important and interesting part of the market that we can invest in, particularly with companies with some of the trends that we're seeing at the moment, particularly with coronavirus, the move to online and digital, and increasingly the shift to a greener economy. There's going to be a significant need to retrain people with new skills to adapt to this new economy. Now, strategic education, their particular focus is on adults who haven't had the opportunity to have tertiary education after leaving high school, generally because they haven't been able to afford it, and they want to, as mature students, they want to go and get further education. And strategic is particularly focused on that group, and they've developed this new product, which is called Workforce Edge, which is in partnership with employers, with corporates who want to provide training opportunities for their employees. And the product enables employees to have access to a wider range of university courses at discounted prices. And because of the way that it's organized, it really eliminates a lot of the bureaucracy, which is typically the barrier to people actually fulfilling these development courses. So it really makes it much easier for employees to access these courses. And we think it's a really interesting model that the company has a lot of ambition for as well. At the moment, about a third of their revenues come from corporate partners. They're now making this available, this new product, to 750 corporate partners, and they expect that to grow significantly as a proportion of their revenues. The market size is truly humongous for employee-based training. $83 billion a year is spent on training and education within the corporate setting, and that's the market that Strategic are after with this new product. Okay, three last examples that I just want to give you are really breakthrough products, and in some cases kind of unexpected as well. RENISHAW is a UK business, and their main business is in metrology, which is essentially probes and devices for very accurately measuring the quality of manufacturing processes, how precisely things are being manufactured. And they have these probes to make sure that products are being manufactured to their specifications, and in that way help make the manufacturing process more efficient and less wasteful. But their big thing is really about precision, having an incredibly precise measurement. And they've used those skills and are now applying them in a healthcare setting by developing a new device for treating Parkinson's disease. And you can see on the left-hand side the chart showing how Parkinson's disease is, the numbers of cases are growing. And they've developed this new technology that essentially involves implanting a device into the brain, as you can see on the right-hand side. So you need to be very, very precise in the way that you do that, using a robot that RENISHAW also make. And then the device delivers the drug directly into the brain. And that doesn't just treat or alleviate the symptoms of Parkinson's disease, which is what the current technologies do, or the treatments do. It does actually slow the progression of Parkinson's as well. So it's potentially a very impactful product for people suffering from this horrible disease. It's still quite a long way off. They've just got through the first phase of their clinical trials for the actual drug, which look promising, but there's still a long way to go before this becomes a commercially viable product. But if it does, then it is a game changer for RENISHAW. The market is, it's about a £6 billion market. If they have a 25% market share, that's about £1.5 billion in annual revenues, which is, more than double their total annual revenues at the moment. So again, a real game changer for them, but quite a long shot at this point still. And then finally, two very topical points that we get asked about quite a bit now, and Ted also mentioned hydrogen and the interest in hydrogen. Hydrogen, as I'm sure many of you already know, is an interesting product because it potentially can play a role in helping to address the intermittency of renewable power generation. You can produce hydrogen using electrolyzers, using electricity that's generated from renewable resources to produce what's called green hydrogen. So zero carbon hydrogen, which you can then store and use for power generation when the sun isn't shining or the wind isn't blowing. So potentially a very interesting application there. You can also potentially use hydrogen in other hard to decarbonize sectors like heavy goods vehicle transport and steel manufacturing and things like that. So green hydrogen potentially is very interesting. There's been a lot of interest in companies that have exposure to it, but it's still, in our view, a long way away. In the middle there, you've got a chart showing the cost of green hydrogen. Grey hydrogen is what's produced from natural gas. Blue hydrogen is where you produce hydrogen from natural gas and then you capture the carbon emissions and sequester them. And both of those, particularly green hydrogen, is still much more expensive, and there's many years, we think, before it becomes commercially viable. But the potential is huge, and the way that we've invested in this is through a company called LINDE, which is a very large industrial gases business with an existing business around supplying oxygen and hydrogen and other gases to downstream industries to help them become more efficient. But because they know all there is to know about handling industrial gases, they're very well placed for the emergence of the green hydrogen industry. They have over 100 pilot projects, all the way down the value chain for green hydrogen. So we think this is a much safer way of playing the emergence of green hydrogen, which we still think is a few years away. And then finally, before I hand back to Ted for the final slide, TPI Composites is a US business that is the largest outsourced supplier of wind turbine blades. So their main business is making wind turbine blades for Vestas and Siemens Gamesa and the other wind turbine manufacturers. But the knowledge and skills they have in making what essentially is very lightweight epoxy resins have also become an increasingly important in transport, making, particularly electric vehicle transport, making the vehicle lighter allows you to get much greater range from a battery, which of course is a critical issue with electric vehicles. And so increasingly they're using their skills around epoxy resins to manufacture these bus bodies, as you can see on the right hand side there. It's about 10% of the company's revenues today, so it's still a small part of their revenues, but with growth in electric vehicles, annual growth being anywhere between 25 and 35% for the next decade at least, this is a market that looks like it's going to grow very quickly, and the company is extremely well positioned to capture new business from this new from the automotive and heavy goods vehicle market alongside their wind turbine business. So those are just 6 examples of some of these breakthrough technologies. Ted, am I handing back to you for the final slide?
You don't have to, Seb. I mean, the final slide is the Q&A slide, so we can sum up and then go on to that. I mean, the point, of course, to put all of this together, as I hope as Seb explained, clearly when we think about the stocks that we own and we think about having our long-term horizon to try and find really good companies that solve sustainability challenges, there's lots that goes into our decision as to what to own. But if we can see companies which have got a pretty clear frame for where the technological pathway is and what they want to invest in for the next generation of where their business is going to come from, then that's very attractive. And if they're prepared to, in a sensible way, allocate capital to incubate these businesses, then that is something that we look for them to do, because we want to be with the companies which are facing the industries of the future rather than just responding to their existing demand patterns. So that's kind of the summary for that part, I think. And with that, we'll go to Q&A.
Thanks, gents. That was great. Seb, it's really a useful taste of some of the exciting technologies that are already becoming a reality. We've received a number of questions, and I can see we've got about 25 minutes, so I'm sure we'll get through a lot of them. I'm going to try and group them into themes, but it does become a little bit more difficult when questions continue to come through once we're already underway, but let's see how I do. The first question, which Seb, I think is probably best for you, is, are the economics and environmental impact of renewable energy really as positive if we consider the full life cycle of these solutions, including the production, the commissioning, and the disposal of wind turbines, batteries, solar panels, etc.?
Mm-hmm. Yeah, thanks, Adam. Well, I think there's a number of different ways of answering that question. I mean, there was a time when there were concerns about the so-called energy return on investments in solar and wind, and some questions to whether they ever generated as much energy as it costs to produce them. I mean, that argument has been long gone, really. I mean, for a solar panel now, it's less than a year in terms of the energy payback, and of course these things last for sort of 25 years and longer. And it's similar for wind as well. So from an energy point of view, there's no question that these are massively positive from an energy point of view, and obviously it's zero carbon energy. There are still, though, issues around the life cycle of wind turbines and solar panels. In fact, we're doing some work at the moment with TPI Composites, talking to them about the recyclability of wind turbine blades. There have been a couple of stories about wind turbine blades just being buried or burnt. And we had a call actually just last week to talk to them about some of the new technologies that they're introducing that will allow you to recycle these blades more easily. And there is a lot of work being done as well by other industries. I mean, wind industry is actually a relatively small user of some of these plastic resins that they use. The electronics industry is by far the biggest, and also the aerospace industry. But all these industries are working together at finding ways to more easily recyclable some of these materials. But that is clearly an issue that needs to be addressed. But on an energy point, no question, wind and solar massively produce much more energy than is used in their manufacturing.
Great, thank you. The next question is from someone who's obviously very concerned about animal welfare, and they have spotted Archon in our portfolio. Perhaps you can start by explaining what Archon does for the rest of our listeners and why you consider it thematic. And perhaps while you're answering that question, you can just explain your perspectives on animal welfare, animal agriculture in general.
Yeah, sure. So ICON is a contract research organization. So they do the clinical trials on behalf of their pharmaceutical clients. So when a new drug is produced, and it goes through this trial process, and they manage the clinical trials process. They only do the human trials, though. So I think that's stage 2 onwards. So the earlier stages might involve animal testing, and in fact, sometimes they're often obliged to use animal testing. But ICON doesn't get involved in that. They're in the latter stages, which involve testing on people. So they don't have any exposure to animal testing. I mean, we don't have our policy on animal testing is because we invest in health. There is going to be some exposure to animal testing, not directly, typically, like ICON, they don't do it themselves, but there is, as you develop new drugs, you have to take them through a process of animal testing. And that comes with being an investor in the health industry. So we don't have a negative screen on animal testing for health, but we do engage with companies where they may outsource it to third parties, and we, as I'm sure many of your listeners know, there are various policies around the so-called 3 Rs, where you focus on refinement, a replacement, and reduction, and other good policies to reduce the use of animals in testing. But because we invest in health, we have to have, there is some exposure there.
And more broadly, sort of agriculture, and there is also a question here, if we stick with the agricultural theme, about is there any exposure to soil improvement in any of your companies?
We would love there to be, sorry Seb, I mean, and unless Seb corrects me, I'm not aware of it. We are looking very closely now at the transition. So, I mean, where to start on this? So, one of the great challenges for CO2, the sort of final end game of CO2 abatement, after you do the energy piece, you have a technology pathway for that, transport, we're well invested in the EV transition, then you go through industry and buildings. The big challenge as you get out to 2050 is aviation, but also food really is the big one. But of course, the advances we made in cultured protein meat replacements in the last sort of 5 years, of which this company Beyond Meat is kind of the sort of flagship, but actually there's an awful lot of work going along, a lot going on all the way along the value chain, makes us think the next decade is going to be extremely interesting for changing global agriculture. And it's so profound because if you think, I mean, literally millennia of human existence, the way that we interact with the soil, and actually suddenly you don't necessarily have the intensive feedstock cropping that's needed with the very high rates of fertilizer and pesticide use, and then all the sort of negative environmental side effects that go with actually raising heavy hooved animals themselves, obviously most prominently cattle there. So sorry, long answer. We're very excited about it. We're very excited about both from the biodiversity side and from the decarbonisation side. It's not easy to invest in it just yet, even in the replacement side. And as for stuff which is soil improvement, I mean, soil improvement, you kind of need to get a lot of stuff off the soil, as in you need to take a lot of equipment off the soil, a lot of chemicals off the soil. You need to let it regenerate, and it's just hard to see how you can economically, how that would be a business. So I'm going to hand over to Seb in case I've missed something there, but are there soil companies that I'm not thinking of?
Not that I can think of either, but it is like Ted says, it is a massive area of innovation at the moment, and an area that we're continuing to look at very closely. And DSM is just one of the ways in which we're hoping to get exposure to lower impact food and agriculture.
But it's a huge. By the way, I should say it's even clearly. So as everyone, parts of everyone on this call knows, it's a big deal. Soil degradation is a huge deal. Yeah.
What's your take on the fact that the production of hydrogen relies on the use of huge amounts of water in the production process? It doesn't seem to make sense for somewhere like Australia, where drought and water scarcity on the eastern seaboard are major issues. I imagine this is not such a problem in Europe.
Well, certainly not in the UK. I mean, yes, it's a very good. It's a very good point, and I have to say this announcement in Australia. I'm not sufficiently familiar with the geography of Australia. I think it's Pilbara or something like that. They're thinking of locating this. I don't know if you've heard about it. This massive solar. I mean, a lot of it's going to be just solar and exporting solar. 26 gigawatts of solar. 2/3 will go to Singapore. So obviously, you don't need any water to produce solar power. But there is also a plan to produce green hydrogen, for which you will need a lot of water. I don't know where Pilbara is. I'm assuming it probably is quite dry, is it? If it's in Australia, my naive knowledge of geography in Australia. But you will need lots of water in order to use the electrolyzer and split it into hydrogen and oxygen. So I don't know. I don't know enough about. I don't think the details of that plan have been released, or at least I haven't seen them to know exactly where that water will come from. But you will need a lot of water. Yes,
I mean the point. Yeah, this is only a topic which I've only briefly touched on. I don't know enough about the actual quantities of how it works, and of course the point about hydrogen is that the LNG industry will tell you that it's ready to transport hydrogen relatively readily. So presumably it's lighter in transport than water, I would guess. Is that right? So potentially you can just transport it in tankers and then use it in source with your fuel cells, and then actually you're producing water, right? Because the fuel cells do produce water. But just intuitively, I'd never thought that the fuel cells would produce enough water to be part of the solution. So I think the WHEB team is going to have to plead ignorance and apologize for ignorance and go back and just have a double check and see whether the numbers there are such that that sounds like a real thing, because it could be. It's not something that's come up. I have to say we've had a lot of conversations about hydrogen recently, and it's not something that people have raised. Which doesn't mean it's not true. We haven't really come across it.
So we will get more information.
We'll get more for you. Yes.
Information from WHEB on this issue, and I'll send it directly to the person who asked the question, and perhaps we'll post it on our webinar website as well.
Yeah. Yeah.
The next question is that COVID-19 has exposed the importance of water and sanitation, and the 3+ billion people not having water in their homes for hand washing, etc. To what extent is WHEB exposed to these themes, and to what extent is this an investment opportunity for the portfolio?
Yeah, I mean,
shall I have a stab? I mean,
yes, go on.
Well, there's a few ways that we have exposure to. I mean, sanitation more generally. Water. We invest in a business in China called China Water Affairs, which is a business that basically supplies water to second and third tier Chinese cities, often to communities that haven't had tap water before. So clearly a big positive impact there. But it's not just about water. We do invest in some other businesses that provide sanitation equipment. So there's a US company called Ecolab, which is also on our water theme actually, but they have a business around sanitation just generally, which includes sanitation for COVID purposes as well. And there's another company that we own called Steris, which is a specialist in sterilization in hospital environments as well. So they again have a particular kind of relevance. It's more of a US business, but a particular focus on hospital sterilization, which is kind of what could be more important really at the moment. So those are three ways that we kind of connect with that issue, not just through water, but through sanitation more generally.
Correct. Moving on to a few questions around stocks and valuations. As responsible investment gains momentum and more money flows into stocks that are deemed impactful, what does this do to valuations, and what is this? Does this make you concerned about future returns?
Yeah. So I mean, the flows into sustainability solutions, well, there's a couple of things. There's the flows into ESG investing in sort of purposeful money, I guess, more broadly, and then there's specifically flows into the impact solutions providers, which is what we invest in. The flows in the impact solutions providers, I think it is fair to say that we are more optimistic about the general regulatory, corporate and personal individual backdrop for sustainability solutions than we have been in the strategy's history. So some of this flow is going to be supported by returns in the future. That's certainly true. Not all of it will. When there's a big movement of capital and a new patch of creative disruption, then certainly some of that money gets lost, and that's just the natural process of these things. And you could very quickly point, for example, at the fuel cell companies. We've just been talking about hydrogen. I think it's just very difficult for us to see that those valuations get justified in anything except very narrow pathways for success. I think the balance of that, as far as we see it, is sufficiently fine that we are focusing kind of as hard as we ever have done in our valuation. Of course, valuation is a big part of our process, so we do see this as a potential risk at the moment. But I think, in many cases you can say, okay, no, there is a case here, and it's not completely excessive. The last point I'd make about this is that there is potentially a philosophical change going on, which is you can think of as the reverse of the famous 1971 New York Times op-ed piece by Milton Friedman, that every company has no obligation other than to make profits for its shareholders first and foremost, which really swept away like 70 years of consensus that companies did have a broader social focus. And actually, what you're seeing now in terms of intentional capital suggests that there may be a new generation of investor who is interested in good ESG companies with very small tail risks, and that will result in something of a permanent step up in terms of the cost of capital advantage of those companies. If that's not all too technical, we're a little bit hesitant about getting too keen on that, but it is possible that companies doing good things will run at a bigger multiple for a long time. In that case, of course, returns are also okay, for slightly different reasons. Long answer, but the point is we're very watchful of it, but it's not necessarily a bubble, I guess, is the way to sort of put it in simple terms.
Thanks. I'm going to ask you to keep them a little bit short and sweet because we do have a lot to get through.
Sorry.
The next question is, will you exit Centene if Trump wins?
If Trump wins, if it's Trump's approach to Obamacare, to me, I find very interesting. Why, you know, it's a sort of market-based response to getting care to individuals and making them take some responsibility for their care. I mean, it could be a Republican policy. He doesn't like it because it says Obama on it, so he'll get rid of it. But the point is, there's going to have to be some market-based mechanism for providing care to poor populations. It's going to look a lot like what Centene do. They're going to be part of the solution. And so if you you lose the exchanges, tips Obamacare out of the boat. In the short term, it looks bad, but these guys know how to provide good, high quality, low cost healthcare. And there just is going to be a place for that in the US, particularly as we wait and see the shape of the unemployment bulge after COVID. So I feel pretty strong, pretty positive about COVID, really. We'll see what happens.
Centene, you mean?
Sorry, COVID, don't feel positive about COVID. Feel pretty positive about Centene.
I was wondering about that. Related to the spread of COVID, in the aged care facilities, is that an additional risk to Centene? And I suppose related to that would be Orpea as well.
Yeah, I mean, obviously it's a direct risk to Orpea to some extent, although they're a very, very high quality operator and they've had a very low instance of COVID. It's been less impactful for them than a bad flu season has been. They were very much on top of it. Centene's at one remove, doesn't operate facilities itself, not, little bits here and there, but basically doesn't operate facilities itself. So it has utilizations issues instead. The complexity of that relates somewhat to the different programs and how they're coping with the COVID costs. But yes, in simple terms, across the medium term, there is going to be some pressure on utilization there, and that's not something that we are so worried about that it changes our view on the stock.
Great, thank you. Seb, I think this one is probably better for you, but is China's 2050 goal on emissions realistic given the size of their population? If so, can we trust that they will actually work towards this? And can we trust the data that they produce along the way?
Well, it's actually it's 2060 that they are hoping to be net zero carbon. So not that that necessarily changes much about the question, but that is the target that they've set themselves. I mean, my view on this is obviously we should be skeptical, but I think it is in their own self-interest to achieve that target. I mean, they already have significant issues around climate change within China. Issues around the Three Gorges Dam and the Yangtze. Those I think they see as threats to stability within China. So it isn't for the good of humanity or for the international order. It's about the survival of China and the Communist Party in China. And I think if you see it kind of in that frame, then it's more likely that they're going to want to succeed. They are obviously the largest polluter today. There's some data that I saw the other day. They're actually on a per capita basis. They're actually now ahead of Europe as well. So in an absolute sense, they're the largest, and per capita they're larger than Europe, although still some way behind the States. So they've got a massive job to do, but they do also have the largest solar and largest wind industries by a long way in the world. So, and they have every incentive to get their transport fleet off of oil because they have so poor domestic oil supply. So, there are all sorts of good strategic reasons why China would want to do this. And it won't be just because of the good of the planet.
Thank you. Next question. We know that free trade is beneficial for the portfolio as a whole. Are you concerned about overexposure to US or the US market, considering the potential instability and the implications for free trade?
Yeah, I mean, yes, well, it's a well-observed point, because quite right, I'm glad that investors have been, paying attention. Yeah, we have had this natural sense that we did like globalized supply chains. A lot of our companies are just to the scale where they have like a product that solves a sustainability challenge, and they sell that globally, and they're plugged into global supply chains, particularly around sort of electronics and high tech. The US side of it doesn't worry me quite so much. I think the US has such a big cost of capital advantage now, and has by far the most robust economy. And of course, it's got actually a relatively small proportion of exports in its GDP makeup. I am very interested in the China-US nexus. That's the area that we've had exposure to before, ever so subtly where we can. We've been somewhat, at the margin, looking to try and reduce that. We've obviously had our companies also do their bit and move their supply chains onto a more resilient basis. I mean, I guess it sort of goes, a couple of ways. If China, on the back of its response to COVID, becomes a very strong, and has in the last 6 months has become has a different growth paradigm to the rest of the world, and of course, not investing in China is tricky. If there's going to be these trade tensions going forward, then you've got to sort of judge where that is. And I think for our money, to be honest, our own personal conviction about what's going on in China makes us hesitant to be overinvested there as well. So this is a key area of focus for us. I think at the moment we still probably are a bit more exposed than we'd like to be, but we are going to have to be careful about how we think about addressing that.
Ted, the last question I think we'll have time for is, can you talk briefly about how you think about
can I talk briefly? Is that the question?
Entry prices and when to sell?
Yeah, I mean, the key points about, when we sell is there's two things really in our frame. Has the sustainability change stopped happening, right? Has this thing that this impactful sustainability driver, has that rolled over? Is there a change in the adoption of that? Have we reached the top of the S-curve? Is there something else that's going on to say that the sweet spot of growth there is gone? That's the interesting point. The other thing you've always got to watch out for is, has your equity, which you've selected to play that trend, has it lost its competitive position? And that's more a company specific question. They're the two kind of like sell discipline things. And of course, you've got the third one, which is selling on valuation. Selling on valuation alone, when you've got a high quality company playing a sustainability growth area, is very difficult, and has been very difficult over the last 5 years in particular. You end up just selling a high quality company. It may dip. We've had this a few times, but then if it's a high quality company, and if the driver's still there, it'll keep going. So that it's some combination thereof, right? Like, we think this sustainability thing has had the best of its time. We think the company's got a bit more competition than it used to have, and we think the valuation is nudging us over the edge as well. So that's the kind of sales discipline. In terms of an entry point, the inverse of those points, have people underestimated where and how quickly this growth drive is going to start? And can we see in, all through the strategy's history, it's been sort of order of magnitude. Can we see 4 turns of EV/EBITDA multiple from where we are now to a kind of run rate valuation? Can we see there's that scope for at least some multiple expansion? And if we can do both of those, then we can get involved.
Great.
Is that brief enough?
That was excellent. Thank you. We have run out of time, so I'm going to wind things up, and we will respond to the rest of the questions directly. But before everyone signs off, there is one last point that I would like to make, and that is this. The strategy shouldn't only be seen as an opportunity for deep green investors who are looking to invest with impact. I think what this year has really shown us is that the strategy provides exposure to a very differentiated source of mid-cap growth. And we expect that the tailwind that has picked up as things like COVID and bushfires have reminded us of some of the challenges will continue to drive long-term performance. And I just really wanted to try and reinforce that point. Our next webinar in the series is on next Thursday with a team from GCM who manage the private equity trust. If you haven't signed up for that, you can do so at pengana.com/webinar. Thank you very much for joining us today. If you have any other questions, please get in touch. We'd love to hear from you. Cheers, everyone. Thank you.
Thank you.